The Drake Hotel has not been demolished. It has not filed for bankruptcy. It has not closed. What it became, in the hands of the ownership structure that acquired it in 1980 and held it across 4 decades of Chicago real estate history, was something more precisely unsettling than any of those outcomes. A fully operational historic hotel whose ownership treated its continued existence as a financial instrument optimized for tax efficiency rather than for hospitality excellence. The Drake opened in 1920 at the corner of Michigan Avenue and East Lake Shore Drive, at the point where the Magnificent Mile meets the lakefront, one of the most commercially and architecturally consequential intersections in American urban history. The building was designed by Benjamin Marshall and Charles Fox in an Italian Renaissance style that established the visual standard for Chicago luxury hospitality for a generation. It had hosted royalty, presidents, and every category of American celebrity that the 20th century produced. Princess Diana had stayed there. The Queen of England had stayed there. Frank Sinatra had stayed there. The Cape Cod Room, its seafood restaurant, had been named one of the best restaurants in America for decades before its closure in 2017. The forensic entry point for this case is not a single catastrophic transaction. It is a slow process, a decades-long pattern of ownership behavior that used the Drake's historic status, its landmark designation, and its real estate position on one of the most valuable corners in Chicago to extract maximum financial value from the asset through mechanisms that had little to do with operating a hotel and everything to do with managing a real estate position for tax and estate planning purposes. The Hilton Hotels Corporation sold the Drake in 1980 to a private ownership group. What followed was not mismanagement in the conventional sense. It was a form of institutional patience that treated the Drake's deterioration as acceptable collateral damage in a real estate strategy whose primary objective was not the hotel's commercial vitality, but the optimization of a land position on Michigan Avenue that had been appreciating for a century and showed no sign of stopping. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The ownership structure that acquired the Drake Hotel from Hilton in 1980 was a privately held entity that shielded its principals from the disclosure requirements that public ownership would have imposed. The transaction was not a leveraged buyout in the conventional sense. It was a private real estate acquisition in which the hotel operation was secondary to the land position, and the land position was valued not for its current income-generating capacity, but for its long-term appreciation potential as one of the irreplaceable corners of the Chicago lakefront. The covenant that no party to that transaction read carefully enough was not written into any loan document. It was written into the Drake's landmark designation, granted by the Commission on Chicago Landmarks in 1998, and into the broader regulatory framework that governed the treatment of historically significant structures in the city of Chicago. The landmark designation created obligations that the ownership had not fully priced at acquisition and that accumulated in cost and complexity over the subsequent decades as the building aged, and the deferred maintenance that private ownership had permitted became a documented liability that the designation made expensive to ignore and prohibitively complex to resolve through demolition or significant alteration. The ownership's response to the deferred maintenance problem was neither remediation nor disposition. It was a pattern of minimal compliance with the landmark designation's maintenance requirements, combined with the tax treatment of the asset that capitalized the building's deterioration as a depreciable asset on the ownership's balance sheet, while the actual physical plant deteriorated at a rate that the tax depreciation schedule did not reflect. The gap between the building's book value, as carried on the ownership's tax returns, and the building's actual condition, as documented by independent engineering assessments commissioned in the context of potential sale processes, was the structural lie at the center of the Drake's ownership history. That gap is not unique to the Drake. It is the standard operating condition of privately held historic hotel assets across the United States, where tax code provisions governing the depreciation of historic structures create incentives for ownership behavior that maximizes tax efficiency at the cost of physical condition. The Drake is the most precisely documented case of that pattern in the Chicago hospitality market. At what point does a tax strategy applied to a historic hotel become an act of institutional negligence toward the building itself? Leave your analysis in the comments below. The appraisals conducted in the context of the various sale processes that the Drake Hotel entered and exited between 1980 and the present produced valuations with the range so wide that the divergence itself constitutes the forensic finding. Independent appraisals of the Drake conducted at different points in its private ownership history have produced figures ranging from approximately $50 million to an excess of $300 million. Depending on the methodology applied, the assumptions made about the cost of restoring the physical plant to competitive condition, and the weight given to the land position versus the operating business. That range is not the product of appraisal error, it is the product of a genuine uncertainty about what the Drake Hotel actually is as a financial instrument. If it is a hospitality operating business, the appraisal must account for the capital expenditure required to restore the physical plant, the competitive landscape of the Chicago luxury hotel market, and the revenue trajectory of an asset that has been losing market position to newer properties for 2 decades. Under that framework, the Drake's value is constrained by the cost of what it would take to make it competitive again, which independent assessments have placed at between $150 million and $200 million of renovation investment before reopening. If it is a land position on Michigan Avenue at Lakeshore Drive, the appraisal is unconstrained by the building's condition because the land value is independent of what sits on it. Under that framework, the corner is worth what the most aggressive developer in Chicago would pay for the right to demolish the building and build something that the lakefront location can support at current market rates, a figure that the landmark designation complicates but does not eliminate as a theoretical ceiling. The ownership has oscillated between these two frameworks for decades without resolving which one governs. The result is an asset that has been simultaneously too valuable to sell at a price that reflects its condition and too complicated to operate at a standard that reflects its location. The appraisal methodology has never been forced to choose because the ownership has never been forced to transact at a price that would have required the choice to be made. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The Drake Hotel's most recent chapter in its ownership history involves a sale process that began in 2018 when the private ownership listed the property with a stated asking price that reflected the land value framework rather than the hospitality operating business framework. The listing communicated to the market that the ownership was prepared to sell to a buyer who would demolish or significantly alter the building, landmark designation notwithstanding, if the regulatory environment could be navigated to permit it. The City of Chicago's response to that signal was the architecture of institutional denial specific to this case, a series of preservation interventions, zoning discussions, and political statements that communicated the city's interest in the Drake survival without providing the financial mechanism that would have made survival commercially viable for a seller whose asking price reflected 4 decades of accumulated real estate appreciation. The city wanted the Drake to be preserved. The city was not willing to pay the price that preservation at the ownership's basis would have required. The ownership was not willing to sell at a price that reflected the building's actual condition rather than its land position. That three-way deadlock between the ownership's price expectation, the preservation community's outcome requirement, and the city's financial constraint produced the specific form of institutional paralysis that defines the Drake's current condition. The building is not demolished. It is not restored. It is not sold. It is maintained at the minimum standard that the landmark designation requires, operated at a fraction of its historical occupancy, and carried on a balance sheet that reflects a land value that the building's condition does not support and a depreciation schedule that the building's physical reality does not match. The Cape Cod room closed in 2017 after 80 years of continuous operation, citing economic conditions. The closure of the Drake's most historically significant food and beverage operation was not a financial accident. It was the most visible symptom of an ownership strategy that had been treating the hotel's operational excellence as optional for decades. The building is open. The institution is not. The Drake Hotel was acquired in 2021 by Hilton through a transaction that returned the building to the company that had sold it 41 years earlier, under a curio collection flag that positions the property within Hilton's portfolio of independent hotels with historic character. The acquisition price was not publicly disclosed. The renovation plan that Hilton announced as part of the acquisition committed to a restoration investment that independent analysts estimated at between $100 million and $150 million, covering the guest rooms, the public spaces, the food and beverage operations, and the mechanical and structural systems that 4 decades of deferred maintenance had compromised. The renovation began. The Cape Cod room has not reopened as of the time this episode was produced. The timeline for the Drake's full restoration has not been publicly confirmed with the specificity that would allow independent assessment of whether the committed investment is adequate to restore the building to a competitive standard in the current Chicago luxury hotel market, which has absorbed several new properties in the decade since the Drake began its most visible period of decline. What the Drake case reveals about the broader pattern of institutional failure that this channel documents is the specific risk created when private ownership of a historic asset treats the asset's cultural significance as a shield against the market discipline that would otherwise force a resolution. The Drake's landmark designation protected it from demolition. The Drake's landmark designation also protected its ownership from the pressure to sell or invest that a non-designated asset in the same deteriorating condition would have faced. The designation was simultaneously the building's protection and its captor. That dynamic is not unique to Chicago or to the Drake. It is the operating condition of hundreds of historically designated hotels across the United States, whose private owners have discovered that landmark protection is a more useful financial instrument than hospitality excellence. The building survives. The institution inside it is being rebuilt, slowly, expensively, and with no guarantee that the market it is being rebuilt for will be the market that exists when the renovation is complete. The marble has waited before. It is patient. The renovation budget is not. If this case file changed how you evaluate the ownership structures behind historic hotel assets, subscribe to this channel because the next case examines a building that a city built to announce its arrival and that the market answered with silence. And in the comments, given the 41-year gap between Hilton's sale and repurchase of the Drake, what specific covenant in the 1980 sale agreement would have prevented the deferred maintenance cycle that produced the building's current condition? The case file is open.